So here, corporate governance includes, so what is corporate governance? It includes all of the means by which business are directed and controlled. So how a business is directed and controlled in what means, all that will be considered under corporate governance. That includes what rules you have in the organization, what regulations, what are the processes you have, what customs you follow, what policies, what procedures, and institutions and laws that affect the way the business is administered. Also, corporate governance involves relationships among various participants and stakeholders, like such as board of directors. What is the duties of board of directors? Then shareholders, CEO, and managers. So all this will be coming collectively under corporate governance. So it can be the rules of the organization, regulations, process, policies and procedures, even your the relationship among various participants. So here we are discussing how a company will be formed first. Then we will discuss the rules, regulations, responsibilities of each positions and all. So normally, US corporations are formed under authority of state statutes. So in US, every state will have authority to form a corporation. And application for a charter must be made to the proper authorities of state in order to form a corporation. Suppose somebody wants to start a corporation, they have to fill an application with state authorities first. And the charter so this is application for a charter. The charter is referred to as the Articles of Association or Articles of Incorporation or Certificate of Incorporation. So you are actually, as a company, applying for a charter, and it is also called as Articles of Incorporation or Certificate of Incorporation. And this charter will include what? Charter will include name of the corporation, length of corporation's life, how long it is going to be, what's the purpose of this corporation organization, and what's the nature of business, and how many shares are there authorized to issue, and if there is any provision for amending any clause in articles of incorporation, how this can be done, and all the information like whether existing shareholders, do they have the right to buy the new shares? When company is issuing new shares, the current shareholders have the right to buy the new shares. The names and address of incorporators whose powers terminate upon filing. So when a company is starting first, who will be doing all the procedures or who is authorized to do all the procedures? They are incorporators. So once the company is formed, their powers will be terminated. So we call them as incorporators. The names and address of the members of initial board of directors whose powers commence upon filing. So now once the company is filed or it is incorporated, now the powers of incorporators will go away and the new board of directors selected, their powers will start and their names and addresses will be there in the charter. The name and address of corporation registered agent for receiving service of process and other notices. So who is the registered agent for the organization? All of these things will be there in the charter. Normally, a corporation is usually recognized as a legal entity as soon as articles of incorporations are filed or when certificate of incorporation is issued by the state. So once the certificate of corporation is issued by the state, the organization or the corporation will become a legal entity. So this is how you will form a company in US. Okay, again, it is in US. We are talking about US. Now you have the articles of association or articles of incorporation. So after articles of incorporation have been filed and certificate of incorporation has been issued by the state, the following steps must be carried out. So once the incorporation certificate has been issued, so you have to follow the following steps. The incorporators, they will elect directors if they are not named in the articles. The incorporators who were initially forming the company, they will elect the new directors. If they are not named in the articles, if their name is not there in the articles, then they can select the directors. Then incorporators will resign. The directors meet to complete the organizational structure. So now incorporators will design and directors are selected, or directors will meet to complete the organization. And at this meeting, they adopt bylaws for internal management of the corporation. So we can think like this. You have a lot of shareholders. All the shareholders cannot participate in the decision making of the company. So the shareholders will choose directors. These are the directors. And these directors will be involved in choosing the management, who is going to manage the company, including CEO. Okay, so that is going to be the structure. So first it comes shareholders and their representatives are the directors. These directors normally are independent, means they don't have not direct any interest in the company. And they will choose the management and other committees and all that we will see in the coming slides. So now they will adopt the bylaws. And what are the things you can find in the bylaws normally? There are a few items here, what you will find in the bylaws of the company. The requirement for annual meetings of shareholders. So when the meeting should be conducted and the requirement for annual meetings and specification regarding what constitutes a quorum. For example, if you have 10 people in the board and how many directors should be available in the meeting to make that meeting a valid one. So what's the quorum? So at least 5 should be there, for example. So that will be there in the bylaws. And also it will mention how directors are to be elected by shareholders. So it will be mentioned in the bylaws. The number of directors, how many directors will be there, and what will be length of their terms, how long they are going to be in the position. And specifications for meeting of board of directors and for what constitute quorum at the board meeting. So again, in the board meeting, how many directors should be there and what are the specifications for the meeting? All those things will be there in the bylaws. Then how officers are to be elected by board of directors. So board of directors now will elect the officers. So how that can be done? Officer positions and responsibilities of each officer position. So what are the positions available and what are the responsibilities of each position that will be mentioned in the bylaws, and specification for payments of dividend, how payments of dividend will be made. Is it going to be a constant dollar amount or it is going to be a constant percentage amount? Those things will be there, and how bylaws can be amended, and there can be a lot of other things also. These are some of the things you will find in the bylaws of the organization. This is talking about what are the responsibilities of board of directors. The board of directors who are elected by the shareholders, actually, the directors will be elected by shareholders. So what are their responsibilities? Board of directors of the company is responsible for ensuring that company is operated in the best interest of the shareholders. So they have to make sure that company is working towards the interest of the shareholders. And the board's general responsibility is to provide governance in the organization, guidance, and oversight of the management of the company. The governance, guidance, and oversight of the management of the company. So normally the directors will be some experts in their own field. Maybe you will have a financial director, maybe you will have HR director. They will have years of experience, and they'll be able to make any suggestions or to give guidance for the organization. And specific related to internal control include so their responsibilities that include selecting the management, including CEO. So directors are going to select the management and defining expectations of management regarding companies, regarding integrity and ethics. So definition of what is expected from this management. Maybe directors are going to choose a CEO and the management at each level, maybe HR leaders, the sales leaders, the logistic leaders, whatever it is. So what is expected from them? So they will define the expectation from each of them and playing a role in strategic objective setting and planning. So where the company should go, what is the operational objective, or what is the objective in terms of reporting? What is the strategy of the company for the future? That will be again set by, or the directors, they will be involved in setting up the strategy and objectives. Investigating issues that they judge important. So if there is any major issue, then they have the right also to do investigation for that. The board members, they are responsible for questioning and scrutinizing management activities. So activities of the management who is running the business, they will be questioned or their activities will be scrutinized by the board members. So therefore, it is important that board members who are independent of the company, they should not be they should not have any special interest in the company. They should be a third party. They should be coming from outside of the organization. They should be independent individuals. They don't have any connection with the company. So an independent director has no material relationship with the company. So they should not have any relationship, material relationship with the company. An independent director is not an officer or employee of the company and is not active on the day-to-day management of the company. So a director should be someone who is from outside of the company, or they don't have any material influence or material relationship with the company. They are not shareholders of the company. They are not officers working in the company. They should be completely an unrelated party. And most of the board of directors, they carry out their duties through committees. So this board of directors, they will form a committee. For example, budget committee. So experts from the budget, they will have a committee. Maybe 3-4 directors will be working for the budgeting. So committees are made up of selected board members and are smaller working groups of directors. So maybe 3-4 directors working together for auditing purpose or making decision about auditing. So that we call it as audit committee. So it's a group of directors. One of the committees whose members is prescribed by SEC regulation is the audit committee. So as per SEC, they prescribe all the public companies should have an audit committee, and they will have certain rules, responsibilities, and rights. This is responsibilities of the chief executive officer or CEO. Now, the board of directors, they are electing a management, and normally the management is led by CEO. And what is his responsibilities? The responsibilities of CEO are determined by corporation board of directors. The board of directors will determine the responsibilities of CEO. A CEO's responsibilities and authorities can be extensive or they can be very limited, depending upon how much authority and responsibility the board of directors delegates to the CEO. So how much is delegated by the board of directors on them? Based on that, the responsibilities of CEO may maybe vary. A CEO should not serve as chairman of the board of directors. CEO is actually handling the management, so he should not be a part of board of directors, and he should not serve as chairman of board of directors. Since the board's responsibilities include monitoring the CEO should not serve as the chairman of the board because that creates conflicts of interest. So in the board, CEO should not be there because board is going to oversee the management, and CEO represents the management. So he should not be, or he should not serve as the chairman of the board. CEO would be leading the body that would be monitoring the CEO. In such cases, what will happen? If he is the chairman of the board, then you can say CEO is actually leading a body, and that body will be monitoring the management, which is led by CEO itself. So that doesn't make sense, or conflicts of interest will be there. So CEO cannot be chairman of board. This is talking about election and removal of directors. The shareholders elect the members of the board of directors. The shareholders will be selecting the members of board of directors. Usually each share of stock is allowed one vote, and usually directors are elected by plurality, or we can say who gets most votes is selected. So directors are selected by the shareholders. Now, length of the director's term of office is set in the corporate bylaws. So how long they are going to be there in the position, that is set in the bylaws. And the term is usually 1 year, but it may be longer, such as 3 years, in staggered terms. So staggered terms means maybe if you have 10 directors, there will not be election for all the 10 directors together. Maybe 3 directors will be elected in first year, 3 directors in the second year, and 4 directors in the third year. This is what we call this in the staggered form. So maybe it can be 3 years, with 1/3 of the board members up for election at each annual shareholders meeting. Only 1/3 of the board members will be up there for the election. So all the 10 will not be there. So holding staggered elections provides for continuity on board, as there are always some returning board members. So when it is staggered elections, at least some people already who have experience in the company will be there in the board, and that will help the organization to get continuity in managing the company. And we said normally board of directors, they will perform their duties through committees. Committees means a group of directors. The audit committee is what we are going to discuss now. What is audit committee? Audit committee is a committee of the board of directors made up of members of the board of directors of the company. So maybe few members in the board of directors, they will form an audit committee. And audit committees of the boards of directors were first recommended by SEC in 1972. It was recommended by Securities and Exchange Committee in 1972. Then stock exchanges began requiring or at least recommending that listed companies should have an audit committee. At least stock exchanges started recommending that at least listed companies, public companies should have an audit committee. Then comes Sarbanes-Oxley Act, or we call it as SOA, of 2000 to increase audit committee's responsibilities further. It also increased the qualifications required for members of audit committee. So this Sarbanes-Oxley Act that increased the responsibilities of audit committee, and also it increased the qualification required for the members of audit committee, and also increased their authority in the audit committee after the Sarbanes-Oxley Act 2002. So what are the requirements of major requirements for audit committees? They should consist of at least 3 members. Audit committee must have 3 members at least, and they should be independent, or we can say they are not employed by the company. And at least 1 member should have accounting or financial management expertise. Out of these 3, 1 should be having expertise. Maybe he should be a CPA or whatever it is in the countries, CA, something like that. And all members must be financially literate. At the same time, all members should have literacy about finance. And New York Stock Exchange requires 5-year cooling off period during which former employees of the company or its external auditor are not allowed to serve on the audit committee. Suppose you are an employee in the company, then you have to wait for 5 years to be a part of audit committee. If you have to resign and you have to wait for 5 years. So that's what a 5-year cooling off period during which former employees of the company or its external auditor are not allowed to serve on the audit. Whether if he is an external auditor or an employee, he has to wait for 5 years after he resigned from the company. And here, what are the responsibilities of audit committee? They will be acting as an intermediary between the management and the external auditor. So they have financial literacy. So they will be dealing with external auditors and they will be giving the result of the audit to the management. So they are standing in between management and external auditor. And they have the right to nominate the external auditor to whom the auditing work to be given. And discuss the scope of audits. So scope of audit means like what should be the type of auditing happening in the organization? Are they going to do a specific work, or are they going to take some samples and they will finish their work, or are they going to go in detail with certain activities? So that's what they will define how the auditing work need to be done. Then review the results of the audit. So once they got the audited financial statement, they have to review it. Also, they have to review the evaluation of internal controls. How is the internal control in the organization is working, that they need to review. And also, they have to review the work of the internal auditors. So normally, internal auditors will be reviewing the internal control, and they are reviewing the work of the internal auditors also. Also, they will review interim and annual financial statements. So maybe if there is any interim means in between, if they issued a quarterly financial statement, that is interim. And annual financial statement, they have to review this. So these are the responsibilities of audit committee. Now from here onwards, it is all laws. Completely talking about laws. So legislative initiatives on internal control. So what are the laws enacted to support internal control? So there are handful of legislative initiative regarding internal control issues that we'll look in more detail. The first one is FCPA, or we call it as Foreign Corrupt Practice Act. Also, you have Sarbanes-Oxley Act. And under this, you have a lot of subsections like SEC Release 338810, like that. So first we will check what is stipulated by Foreign Corrupt Practices Act. This act was passed in response to the discovery in 1970s that American companies were making large, questionable, illegal payments to foreign governments, officials, or politicians. So during 1970s and all, it was found that American companies are making huge amount of payment to get business from other countries. So they are making inappropriate payments to the governments or officials of the government or politicians. So they are making these payments. So this is what we call it as Foreign Corrupt Practices Act. So this law was made to protect or to stop those kind of activities. So this is an amendment of 1934 SEC Act. And in this act, in FCPA, there are two main provisions. One is anti-bribery provisions. Other one is accounting provisions. There are two provisions in this. One is anti-bribery, other one is accounting provision. So what is anti-bribery provision is stipulating? So anti-bribery provisions apply to all companies, whether they are public company or not a public company. This applies to all the companies in US. Accounting provisions, whereas it is applicable only to companies that are under regulations of SEC, or we can say this is only for public companies. Accounting provisions are mandatory for public companies only, but anti-bribery provision is applicable to all the companies in US. So as per anti-bribery provisions, we can see it is illegal to offer or authorize corrupt payment. It is illegal to offer an amount or authorize an amount, which is we consider as a corrupt payment, to a foreign official or a foreign party chief or official or a candidate for political office in a foreign country. So it is illegal to offer them, or it is illegal to authorize a corrupt payment. It is also illegal to make these payments through another party. Maybe someone, maybe they don't want to come in the limelight, or maybe they don't want to show their face anywhere. They will do the payment through an intermediary. Even that is going to be illegal as per anti-bribery provisions. So what's a corrupt payment? A corrupt payment is one that intends to cause the recipient to misuse their position. So you are making some payment to someone so that he will be misusing his position to give order or direct business to the payer of the corrupt payment. So American company is paying money to an official, for example, politician or official of the government, and he's misusing his position to direct the order or direct the business to this particular company, that we consider as a corrupt payment. And as per FCPA anti-bribery provisions, this will be considered as an illegal act. Then comes accounting provision. So accounting provisions of FCPA Act, management is required to maintain records and books and accounts that represent transaction properly. So as per this provision, the management should be maintaining records and books and accounts that represent their transactions. So you have to maintain proper bookkeeping system in the organization as per this provision. Also, management should develop and implement a system of internal control. So why it is coming under FCPA? So when you know that you have proper internal control, for example, if you want to make a payment, there should be proper quotation taken from some 3-4 companies. And out of these 3 companies, one quotation will be approved by the concerned person. And once it is approved, a PO should be raised, and there are certain people need to be signing on the PO. And once the PO is made, maybe you will get an invoice from the supplier, and this invoice may be attached with a delivery note, and this delivery note should be signed by the person who is receiving the products. And delivery note attached with the invoice, it should come to the accounts department with proper signature from the authorized person who dealt with this company. So once it is reached, they have a bunch of papers. They have all the, we can say, voucher package, delivery note, invoice, quotation, purchase order, everything is there. Based on this, maybe an accountant, he will make a payment voucher. And this payment voucher should be approved by the authority. So once it is approved, only they can make a payment. So there are a lot of steps it has to go. Once the payment is made, someone else will be doing the bank reconciliation. So if you have proper internal control like this in the organization, it is not easy for you to give bribing or bribes or something. So when there is a payment, there should be some record somewhere. When the money is going out of your bank account, there should be a record. So you cannot debit bribe account in your company's books, right? So it will be difficult for the company to make such journal entries and all in the accounting books. So logic is that if the company has effective internal control system, it will be more difficult for corrupt payments to be made. Like making corrupt payment, it is going to be difficult when you have proper internal control. And this is talking about penalties of FCPA. So fines for making illegal payments are up to 2 million fines against the company and up to 100,000 fines and 5 years of imprisonment for individuals who make or authorized an illegal transaction. Also, the companies will be prevented from participating in the government contracts. And shareholders also able to file lawsuits against a company for illegal payments. So these are the penalties of FCPA. So again, this is another legislative, which is Sarbanes-Oxley Act. And what are the things mentioned in Sarbanes-Oxley Act about internal control provisions? The Sarbanes-Oxley Act was enacted in 2002. Its provision with respect to internal control are. So what is mentioned in this as per this act? Audit committees to be responsible for appointment, compensation, oversight of the registered public accounting firm. So who will be the auditor? and how much amount should be paid to them, and it will be appointed by the audit committee. This is mentioned in Sarbanes-Oxley Act. And audit committees to have authority and funding to engage independent counsel and advisors as deemed necessary. If audit committee is feeling that there is a special scope of work is needed, so then they will have the authority about funding and engaging such independent counsel. And auditors are report directly to audit committee. The external audit companies will be reporting to audit committee, and members of the audit committee must be truly independent. They should be out of the company, the members of the audit committee. So all these provisions are there as per Sarbanes-Oxley Act. And also, it is unlawful for any corporate officer or director or person acting under their direction to fraudulently influence or force or manipulate or mislead any accountant engaged in preparing an audit for the purpose of causing an audit report to be materially misleading. Or we can say no CFO, no CEO, nobody can direct any of the accountant or someone to do misleading, misleading entries in the books of accounts. And also, as per this law, the company's annual report, it should be filed with SEC. Annually, they have to report, they have to file a report with SEC. So this report must be accompanied by a statement of management that management is responsible for creating and maintaining adequate internal control. So there should be a letter along with the reports from the management that they are responsible for creating and maintaining adequate internal control. And also, if there is, also they have to make a statement that with a statement of management assessment of the effectiveness of this control. So what they feel or what they think about the effectiveness of the controls that they have in the organization. So their assessment, is it good or is it bad, whatever it is, their assessment also should be there as per this act, Sarbanes-Oxley Act. And Sarbanes-Oxley internal control provisions. So there will be like more provisions. Under this, you have different provisions. So there are several main aspects of Sarbanes-Oxley or SOX that will be now covered in more detail. So Public Authority Accounting Oversighting Board, or we call it as PCAOB, SOX Section 32. So that is what actually mentioning corporate responsibility for financial reports. And 404, it is talking about assessment, what we just discussed. That will be there in the 404. And PCOB auditing standard 5 and preferred approach to auditing internal controls. This is Public Company Accounting Oversight Board. So here we can say Title 1 of Sarbanes-Oxley Act established the Public Company Accounting Oversight Board to oversee auditing of public companies that are subject to securities laws. So this is Public Company Accounting Oversight Board, or PCOB. What is their purpose? The purpose of forming this body is to oversee the auditing companies. And this board will be normally 5 board members appointed by SEC, including only members who are financially literate and must be from private sector. So they should be financially literate, and only 2 of the board members can be CPAs, but all of them has to be financially literate. And PCOB has many responsibilities. Its role to provide guidance to auditors on their auditing of internal control is just one responsibility. So they'll be giving guidance for internal control auditing. And their primary responsibilities include what? Registering accounting firms that audit public companies. Or we can say audit companies will be registered under them. And establishing standards related to preparation of auditing reports. So like we have a lot of standards. So this will be prepared by PCAOB. And conducting inspections of registered public accounting firms. The audit companies, public accounting firms, will be inspected by this board and enforcing compliance with appropriate laws and professional standards relating to audit reports and obligations of audit accountants of the firm, and conducting investigations and taking disciplinary proceedings and imposing appropriate sanctions if some misappropriation found in any of the public accounting firms. This is PCAOB, and this is mentioned in Title 1 of Sarbanes-Oxley Act. Then 302 is actually telling Section 302, each annual or quarterly report of the company must include certification by CEO and CFO. So they have to specify that they have reviewed the report and that does not contain any untrue material statement. So that may mislead the report. Nothing like that, it is there. And also, based upon their knowledge and financial statements, fairly representing all material aspects, the financial condition and results of operations of the company. So they have to mention that whatever the financial statements is presented, that is fairly reported. And also they understand that they are responsible for internal control in the organization. So they have to make this statement along with the financial reports what they make. They have disclosed required information to the company's auditors and audit committee of the board of directors, including any fraud that involves the management or any other employee, or any deficiencies in design or operation of the company's internal control. So if any discrepancy is there or any such things, they have to disclose in the report. Any fraudulent activities happen in the organization, or is there any deficiency in the internal control? All this should be reported. And also they have disclosed in report any material changes in the company's internal control that have occurred after the report date but prior to publication. So auditing is done, but audit report is not issued. Normally it will take 3-4 months, right? So between this time, any material change in the organization happened in terms of internal control that also need to be disclosed in the report. So that's what 302, Section 302. It is talking about corporate responsibility for financial reports. And for some reason, these questions are always coming in the exam, like the SOX section, this and all. And Section 404 relates the management assessment of internal control. So this we already discussed. As per this section, it is the responsibility of the management for establishing and maintaining adequate internal control in the organization. And also, they have to do an assessment, contain an assessment of the effectiveness of internal control. How good the internal control is, they have to examine and they have to do their own report. They have to do their own assessment as per SOX Section 404 of the Act. Then you have more section 301, 407, 201 and all. If you want, you can just read it. I'm not explaining this because it is rarely, I never saw these questions anywhere. Before, there was actually in section C, there was three sections actually, three subsections. One was internal auditing, internal control, and system controls. But from last change, internal auditing is been removed as a separate section, but that is included here in the internal control as a small part of it. So this mentions external auditor responsibilities and auditing the internal controls. And also it is talking about audit opinions. Okay, so this is talking about external auditor responsibilities. The auditor's primary job, so what are their responsibilities, is to provide assurance of the reliability of company's financial statements to financial statement users. This is the primary responsibility of the auditors, to give assurance that you can rely on this financial statement, whoever using this financial statement. So they are talking about the reliability. And there can be some risk. What is risk? Audit risk. Audit risk means what? Is the likelihood that the company's financial statements are materially misstated and the auditor expresses an inappropriate audit opinion. Or we can say there are a lot of mistakes in the financial statements and auditors were not able to make an opinion about those. So that's what we call it as audit risk. So audit risk will include inherent risk, control risk, and detection risk. So the audit risk is chosen by the auditor and can vary between firms. So what is audit risk? Audit risk means that maybe I'm an auditor, so there is a chance that maybe I have signed a wrong financial statement. Okay, so some firms are willing to take higher risk of expressing an incorrect opinion, so long as the additional risk correspond with increased audit fees from the client. So we can say there are three types of risk. One is inherent risk. The risks are related to business decisions, culture, and environment of the audit client. The inherent risk means that company itself or this type of business itself is having inherently, there are a lot of risks. It is not easy to do a clean audit for such companies because of their culture, their business decisions, their environment, all. So inherently, there are some risk involved in it. Then there is control risk. This is the likelihood that client's internal control system will fail to either prevent, detect, or correct material misstatement in the financial statements. So you don't have proper internal control. Because of that, you have risk. Or because of that, the auditors are not able to make proper or accurate statements. Or you have third one is detection risk. Detection risk is the likelihood that auditors' procedures will fail to detect a material misstatement in the financial statements, or risk that auditors are not able to detect any of the error in the organization. So when you have all this risk, that is what we call it as an audit risk. So there are some risks that you can reduce. We can say control risk you can reduce. How? By having a lot of internal controls. So when you have very good control risk or very low control risk, you can increase the detection risk. So when you have proper internal control in the organization, maybe you don't have to go deep into detection of the materials or the facts, because you have proper internal control. Inherent risk, this is by the nature of that business, there is a lot of risk. So this we call it as audit risk. So again, section 404 of SOX requires that external auditors attest to and report on the adequacy of public companies' internal controls over financial reporting. So as per 404, even external external auditors have to attest and report on the adequacy of the internal control. Auditing standard number 5 provides guidance for how auditors are comply with section 404. Anyway, no need to go that much detail. Now, there will be different types of opinions an auditor can make. There can be an unmodified opinion. So an unmodified opinion, which is issued when auditors have examined a complete set of financial statements and have gained sufficient appropriate evidence that the financial statements are free from material misstatement. So here there is no modification, unmodified opinion. So it is appropriate evidence and it is sufficient. An unmodified opinion with an emphasis of matter or other matter paragraph. This is another opinion. This occurs when auditors have gained sufficient appropriate evidence that financial statements are free from any statement and feel there is minor issue that should be brought into the attention of financial statement users. So minor issues are there. So that will be brought into the attention of the people. So that we call it as unmodified opinion with emphasis of matter or other matter. Inconsistent application of accounting principles, maybe this is an example. Accounting principle used is not consistent. Going concern doubts whether the company is going to be there for 10 years or long period. Uncertainty about significant future events. Maybe they mentioned some future event, but they have to say the uncertainty about that event may or may not occur. For example, you can say there is a legal case going on, and in the financial statement, it is mentioned that we are going to lose the case. And when in such cases, you can report the expenses. But if the auditors feel that maybe that is not true, maybe they may win the case also. There is a chance. So in that case, they have to do an unmodified opinion. Opinion with emphasis on matter. A modified opinion may be issued for several reasons. For instance, this may occur if auditors believe financial statements are materially misstated. Then they have to do a modified opinion. So it is not as per GAAP. Or if the auditor was prevented from obtaining sufficient audit evidence, they were not able to get enough evidence to prove some numbers. So in such case, they will do a modified opinion. So that means even auditors thinks that there are some financial statements which is materially mistaken. So that is modified opinion. The other opinion is an adverse opinion. This is issued when auditors have evidence that financial statements are materially or previously misstated. So they have the opinion that the statements are wrong, or there are errors, or it is corruption is there. Then they will issue an adverse opinion. Or they can also have a disclaimer opinion. This is issued when the auditor is unable to obtain sufficient audit evidence to make an opinion regarding the reliability of the financial statements. So they didn't get enough evidence to make an opinion. In such case, they will have a disclaimer opinion. So these are the different types of audit opinions that may be made by an external auditor. Unmodified opinion, that means everything is good. And unmodified with a matter or matter paragraph, that means everything is fine, but there can be some small, differences. A modified opinion is like it is materially misstated, or auditors couldn't obtain enough evidence for the numbers what they are presenting. An adverse opinion, auditor is telling no, it is misstated completely. A disclaimer opinion is like they are issued the financial statement, but they mentioned that we believe that this is the number, but we didn't get enough evidence to prove that. So there is a disclaimer. We are not responsible for this. So that's about internal control. Now this is telling what is internal control can and cannot do. Internal control can help organization to get where it want to go. Yes, it can do that. Where company want to go, maybe internal control can help company to go there. Internal control can help organization to achieve its goal and prevent loss of resources. So when you have proper internal control, it is not easy for anyone to manipulate or misappropriate the assets of the company. Internal control can ensure reliable financial reporting. Internal control can ensure that organizations comply with the laws and regulations, but internal control cannot provide any guarantee. They can also provide a reasonable assurance to management and board of directors regarding achievements of objective. It is not a guarantee, it is only a reasonable assurance that you can have. So that